Let's bring in another voice into the conversation. We got Kathy Jones, Charles Schwab Chief Fixed Income Strategist. And Kathy, it's been a bit of a wild ride over the last few days when we're looking at U.S. Treasury yields. We have seen a bit of a bounce back here, now trading at around 1.3%. But we had a guest on earlier who said that we shouldn't necessarily look at the moves as a gauge of sort of sentiment around the economic recovery, largely because there have been so many inflows from outside of the U.S. for those investors seeking yield. How have you been watching the moves?
Well, I do think it's important to pay attention to what the yields have been doing, and I do think they reflect to some extent this sort of ebbing and flowing of concerns about growth. So, we came into the year and people were expecting the pandemic to weigh on economic growth very strongly, and then we got this reopening that was very quick and yields ran up to about 175. And then more recently, we kind of got into this worry that, well, maybe we're past the peak and now yields are coming down. So foreign investments is important in the Treasury market, but I don't think it's a single driver. I do think that this is a reflection of this ebbing and flowing of expectations about how the economy is doing, what inflation prospects are, and what the Fed might do.
How much of those concerns you think around the economic recovery are justified given the more recent data we've gotten?
Oh, I think the recovery's on track. It's really just the rate of change that has slowed, and we couldn't continue to grow at 9 or 10% GDP growth every quarter. So obviously it's going to slow down. I think one of the things that got into the market that sent yields tumbling was actually the idea that maybe the Fed was going to hike rates sooner than anticipated. That sends a signal to the long end of the bond market that maybe the Fed isn't going to tolerate higher inflation for longer and that they're going to step on the brakes sooner rather than later. And that contributed to the decline in yields. We don't think that's going to be the case, though. We think the economy's doing well. Yields will probably bounce back. Probably the lows are in for the time being. And we'll maybe the second half of the year find some sort of equilibrium between these two extremes.
Yeah, I mean, you talk about the FOMC minutes that highlighted that division. We've had a lot of guests on who've come on to say that they think really Jackson Hole is going to be the summit there is going to be the big marker in terms of where the Fed moves, at least publicly messaging that. I mean, it sounds like you think that's still a ways off.
Yeah, I think that we'll hear something about tapering their bond purchases at Jackson Hole. They'll probably start to do it in the fourth quarter. That's been pretty well signaled already. Next week, we have Jay Powell testifying before Congress, however, and I think that actually will be more interesting because we will get a fresher, more up-to-date view of where the leaders of the Fed, the chairman, the vice chair, and the head of the New York Fed, where their thoughts are about policy.
So with that said, I mean, where do you anticipate yields to be moving if we're talking specifically about the 10-year? We're at 1.3 right now. Could it push even lower like we saw yesterday?
We'd have to get some really disappointing data at this stage of the game, I think, to push it back down, maybe test the 120 area. But I don't think that there's a lot of room for it to move a lot lower unless we really get a surprise on the global economy or maybe the Delta variant. It gives us a big global growth scare. I think there's more room for yields to move up than down from here. So we'll probably go back and test that 150 to 160 area as we get into the fall.
What are some other markers that you think we should be looking for? We've talked so much about the shortage in the labor market. A lot of businesses really struggling to fill the positions, which has led to more wage increases, additional benefits being added on. And we've spoken to these companies who've said that it's just a matter of time before they have to pass that down onto consumers. How big of a risk do you see that as?
Well, I think that it is a bit of a risk, but I think it's a risk by design to some extent. So the Fed has said they want to tolerate more inflation rather than less going forward. They missed their 2% inflation target for the better part of the last dozen years. They believe that if they tolerate higher inflation, they'll get lower and lower unemployment. And we have seen the labor market really get restructured here with a lot of people retiring early. So we have a shortage of labor in some areas, which should drive up wages. And yeah, I think companies will try to pass as much of that along as they can. But again, this is kind of by design. But the administration wants to see higher wages. The Fed wants to see higher wages. And they look like they're going to tolerate that because that boosts real income growth, and that's the goal of policy right now. It's very different from what we've experienced over the last 40 years. This is a set of policies designed to boost real income, and if it comes at the expense of capital, then so be it.
Kathy Jones, Charles Schwab, Chief Fixed Income Strategist. It's good to talk to you on this Friday. Have a good weekend.